Well, thank you, everyone. And we'll be picking up where the team before us just left off. Today, we're really going to be talking about Web3. And when we talk about Web3, particularly in the context of an alternative investment management summit, it's really about use case. Is crypto, does it have a use case beyond speculation and gambling? That's something that we fundamentally believe there is. So I think where we really want to start this conversation that is so relevant to how we bridge yesterday's conversations, which were all about alternative investments, markets, macro, with crypto, is asset tokenization and the evolution of investment vehicles. So Staci, would love to hear from your perspective how you see asset tokenization evolving, how you see the evolution thus far. Does it feel like nuclear fusion that's always a couple years away but never quite there, or is it something that really is going to catalyze in the future?
Okay, best panel of the conference right here, ladies and gentlemen. Woohoo! Examples. So I think tokenization is going to be one of the earlier use cases for crypto and for blockchain technology, for sure. And I am the CEO of the Algorand Foundation. Algorand is a next generation layer one, and we're a very performant blockchain. So we're very fast, and we enable instant finality. And things like instant finality and low gas fees or low transaction costs are going to be very important in these tokenization markets, of course. So we are seeing a lot of activity on Algorand in tokenization, and I can give you just a couple of good examples if you'd like. One is, since this is an alternative investments conference, I'll start with an alternative investments tokenization. And there is a company called Control Alt, which I think is a quite clever name, actually. And they are regulated by the Financial Conduct Authority. So they started in 2020. They spent 3 years trying to get this license. And what they enable you to do is to buy very small shares of alternative assets. So it could be a wind farm, it could be an apartment complex, a number of different things. They've got a whole range of assets, and those are tokenized and they are recognized as securities. So you have the same legal rights to these tokens as you would to a security. They're a UK-based company. Another one that I think is quite interesting is called TravelX, and they are tokenizing airline tickets. So if you have, they're based out of Argentina, and they already have a partnership with the Argentinian Airlines. And this is not about breaking up a large asset into smaller pieces, so for Control Alt, you're bringing liquidity to these markets, and you're also bringing financial inclusion. But TravelX enables you, if you want to, it creates basically secondary markets in airline tickets, which benefit the airlines and of course benefit the travelers. So if you are a college student and you want in the U.S. and you want to go home for Thanksgiving every year, you buy your ticket as a freshman for every Thanksgiving to go home. But sophomore year, you get yourself a boyfriend and you don't want to go home for Thanksgiving. You want to go off with your boyfriend somewhere. You can trade that ticket on a market. You don't have to pay a fee. You don't have to try to get it back to the airline. And so this also gives a lot of information to airlines about who is using their tickets, what's happening with them. And it can, very easily, of course, do all the other cool things like enable you access to the lounge and all that kind of stuff. So I can kind of keep going. But I'll give you one more. Vesta Equity is a tokenization of a real estate platform. And what this enables you to do is sell equity in your home. So if you have paid off a lot of your mortgage, you're kind of a boomer, you're getting into your wealth and retirement years, and you want to take some money out of your home, what can you do now? Well, you have to refinance that home. But if you could you could tokenize the equity that you have in your home and sell it easily, and institutional investors or retail investors, but institutional investors can then buy equity in specific homes with full transparency into what that portfolio looks like, and you can have money in your home without having to give up your interest rate or having to pay those refinancing costs. So I think 3 very interesting examples, all live now, all happening on Algorand, which is, of course, the blockchain that I'm most familiar with.
So when we think about that, we're talking about an asset class, crypto, which is in the low single digit trillions that can enable a multi-hundred trillion dollars of assets across real estate, across equities, across goods, services. Andy, would love to hear your perspective on real use cases that you've seen or real implementations, some of the challenges that there have been around. One of the promises of tokenization was liquidity, but it seems to be a missing part of the equation. So we'd love to hear how you've been looking at this and what your views are on tokenization of assets.
Right. So being a manager of a venture capital fund, liquidity is definitely something that's always on our mind for our limited partners. As you know, early stage venture, oftentimes, if a fund takes too long to return capital, there's a whole new asset class called the secondary market, right? Which really is, in a way, it's an inefficiency of our capital, market. Ideally, what you want to do is, our primary stake should be able to trade between our partners in the future, perhaps not mark to market on a minute to minute basis, but at least should be some sort of market allow people to trade. And I believe the reason why it hasn't happened is because the overhead is so high, right? Every time we do a LP stake transfer, it will actually require us to have reams and reams of document. But if you could package all that, tokenize it, at least make the trading a little bit easier. And this is not too different from what Staci was talking about in the real estate. There are a couple companies we're looking at. I'll mention both. We invested in one, so I won't tell you which one we invested in, but I think you should look at both. They're both in the real estate tokenization market. It allows, it's very, very basic. It allows anybody to become a $1,000 landlord, right? So you could tokenize an asset, you could buy into that token, and as the asset collects rent, you as a token holder then gets a dividend check, right, in the form of a stablecoin. And there were two companies, one is called Homebase and the other one's called Mogul. So I think it's pretty interesting. It brings in different asset class, a different sort of investment model to investors that were previously too expensive to implement. I think the challenge then is what Zach mentioned. Where does the liquidity come in? Because you were talking about some of these very unique assets. Ideally, you want to bring in, lots of volume of similar type of assets so you could create liquidity. And this actually brings in the idea of a sort of a permissionless public blockchain. As you can imagine, if everything is permissionless out on public, you could trade, there's volume. But in some cases, almost in all cases, institutions like to keep a little bit of a secret, right? So we want to have our KYC, we want to be legitimate players, but I don't necessarily want you to know exactly what trades I'm making, right? There lies that, that conflict between having transparency and a large pool of capital that's trading for, good prices versus a little bit of traceability in the marketplace / privacy. Not to mention the regulators would like to know. So we have invested in a company called Henkel Protocol that kind of balances those two things. It's got a ZK for privacy, but at the same time, it has a decentralized KYC. So if the regulators need to find out, there's online identity. So all in all, so we hope, technologies like these will bring the fragmented pool of capital together to bring liquidity and make the market more efficient. So some of these currently not possible trading assets that are lightly traded could one day be traded with very low overhead and actually bring better market for all investors.
I would like to make a plug for my breakout session this afternoon, which is chock full of real world use cases. So don't miss it.
What time is the breakout session?
I think it's at 2:30.
2:30.
Just
we won't miss that.
Yeah.
So there's a lot of things that you both said that I really want to unpackage here. Let's remember that traditional financial systems were given hundreds of years to develop organically. Even electronic trading. I remember being at a conference not that long ago, and somebody from the Life Exchange was saying, "Open outcry is here to stay. Electronic trading, there's no liquidity," at that time. He was right on one point. I mean, all the liquidity in the markets that they had on their exchange was open outcry, and electronic trading wasn't there. But it was very clear that the technology for electronic trading.
How old are you? I mean, you look like you're in your 20s and your early 30s. How could you possibly have known about the trading pits and the open outcry?
I'm 35, but I actually got into the markets at a very, very, very young age.
So 6 on the futures trading pit.
So anyway, thank you for your kind remarks on my youthful looks. But anyway, open outcry was overtaken by electronic trading. It was clearly better from a risk perspective. It was clearly more efficient. It's hard to look back and think that anyone could have said that open outcry was there to stay. The jump to it's also not a secret that people see a tokenization, the potential for atomic swap type settlement, the trade and settlement to be happening simultaneously rather than being delinked, and the risk and friction and rent seeking that introduces the system to be a better way. But these things do take time, and liquidity takes time to move from legacy systems into new systems. But there were a couple points that we touched upon here that I'd like to unpackage. One of them, Staci, particularly given your the hat that you wear as a protocol, was the discussion of permission private versus permissionless public. As governments, exchanges, established institutions look at harnessing this technology, there's this tendency to want to go to permissioned, private, very, very strict walled gardens. What would you say to authorities, to institutions, as they take an approach to asset tokenization to guide them towards permissionless and public protocols for enabling those systems?
I would say that the blockchain is a terrible database. If you're going to have a permissioned database, use an Oracle database. It's much more efficient. It's much lower cost. You can have control over it. If you have a blockchain-based network with only a couple of node operators and it's very permissioned, I'm not really sure what you get from that. The benefits that you get from being on a public blockchain are the benefits that you get if you are not trusted by the other parties. If you are very well trusted by everybody interacting with you, then yeah, own the database and say that it's my data and I'm taking care of your data, and don't worry about it. But if you're in a situation where data needs to be shared across parties and each party does not have complete trust with each other, and you need to see that fact that there is that this blockchain is immutable by you can't change it, nobody can change it without everybody else seeing that, then that's where you need a public blockchain. Another very interesting protocol building on Algorand is called Planet Watch, and they track the air quality through sensors. So this is kind of IoT talks to blockchain. Now, you're not going to allow a government to own that data necessarily because, some mayor may end up showing up miraculously better than another mayor in the air quality of their town. But if every mayor is putting these sensors in their area and that data is uploaded immediately onto chain and it can't be good and bad and it can't be messed with, then that's the kind of data that everybody can trust, right?
Just within public permissionless systems, are there solutions for creating walled gardens or creating subsets as a layer 2 where some of the concerns that these parties need to address can be addressed, while still taking advantage of an open system.
Yeah, they're not called layer twos, they're called side chains, but one node can then kind of be the base onto the main chain, and a side chain, a more permissioned side chain can operate off the side of it, so for sure. But then when you want to talk to the world, then you're on this node and you project out to the world. Yeah.
So Andy, would love to hear your perspective on this. You were also an early investor in Tezos, which was one of the kind of forerunners in the area. They were one of the first to do real asset tokenization as well. But what do you think are some of the challenges that have existed at the protocol layer for asset tokenization?
Right. So as I was alluding to earlier, for these financial institutions, oftentimes they prefer to be in the dark pool so they could trade between themselves and not reveal their identity, right? So we actually have invested in two companies that kind of crossed it. One is Web 2.5, the other one is Web 3. 2.5 is kind of a prime broker, right? So they basically help existing institutional investors sort of make that transition. You still tap into the larger pool, but there is a layer that kind of masks your identity, but you lose a little bit of efficiency, but you're kind of the quasi, Web 2.5. And the 3.0 model is the Hinkle protocol that I mentioned earlier that allows you to seamlessly, I think Staci mentioned the sidechain, sort of integrate it into the main pool, but then we put in enough of a KYC that's decentralized, so in a regulatory probe situation, they could always find out who you are. So you're not completely anonymous, but then you could trade and in a permissionless world by joining part of the larger pool through a zero knowledge privacy.
So in effect, the challenges that these institutions want to solve for can easily be solved for. They can be solved for with side chains. They can be solved for with other solutions. And then it kind of begs the question on whether they actually do want to solve those problems or just continue to extract rents. But I'll leave that for another panel. So let's move over to DeFi and the real world bridges that we're creating in DeFi. Dubai has for many years, or in the Middle East in many ways, has been a hub for trade. It's been a hub for trade finance. If you speak to any of the regional banks here, you deal with the regional banks, you'll know that they're experts in trade finance. So would love to hear, Staci, some of your perspectives on embracing DeFi and other segments of the financial system, other segments that touch upon what many of the alternative investors we were speaking with yesterday focus on.
So I have good news and bad news for you. The good news is that the DeFi revolution is coming, and the bad news is that the revolution is not sexy at all. And if you think about what happens in finance, it's all about what's happening in the mid and the back offices. So price discovery will always be done by humans. That's not a blockchain thing. But you and I are trading a bond. We're on the phone. We're like, done, 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 done. Great. Okay, then your mid office goes and writes up a ticket. My mid office writes up a ticket. Those tickets then have to be reconciled with each other. Then it goes to the DTCC. They say, okay, did you give me the money? Did you give me the security? Okay, T+2 later, it's settled. Robinhood, for example, during the GameStop, they had to put up $600 million because of their T+2 settlement risk over the weekend, right? And so if you look at this, if you unpack this kind of thing and take something that you guys hold very near and dear to your hearts, which is securitization, just think about for a minute the securitization model and ask yourselves if it makes sense and if it's not prone to risk and if it's not prone to mistakes. So you have, let's just say, 10,000 mortgages. So every originator, collects money from those mortgage holders. Then all of that is audited by the trustee. The trustee then, the originators give it to the administration agent, the SPV. The SPV says, okay, so there are all these, investors. There's on the liability side, there's a waterfall, right? You've got insurance companies at the top and hedge funds at the bottom. Then you have to go to a calculation agent. The calculation agent has got a bunch of people in the back with Excel spreadsheets saying, okay, how much does this insurance company get of the principal and interest all the way down that waterfall? Then, what happens to it? It goes to a paying agent, right? The capital for the lower tranches goes to the DTCC again. They get sent to prime brokerages. The prime brokerages then go out, distribute cash at a QSIP level to the end holders. Like, am I missing anybody? I'm not even sure.
Any rent seekers?
Yeah, that's
anyone with their hand up for a fee?
Everybody charges a fee for that. Every piece, that's 30 to 40 basis points, right, on your deal. That is not complicated, though, right? That is a very simple, what we call smart contract, but which is actually a very simple kind of if-then statement, especially the calculation agent part. It's like the money comes in, who gets what? It can be updated, almost in real time. And how is that money distributed? And then, of course, you're back to the banking system with T+2. But even so, you could imagine disintermediating very important parts of that and getting back that 30 to 40 basis points, either for the person that's taking out the mortgage or for other players in the system, you holding, you as the end investor in that bond, right? This is happening in pieces already, but the potential for this is pretty revolutionary, actually. So
I'm going to pull in a little bit of macro because I just can't help myself. We're now in a world where interest rates are at much higher levels. When we were in a zero interest rate world, every basis point made a difference. So if we could get just a little bit more efficient, it really mattered. But Andy, I'd love to ask you, do you think that this changes now? Do you think that the search for enhanced efficiency in DeFi, shaving off 10 basis points here, 20 basis points here, is as strong as it was in a macro world? Does it not matter anymore? Or how much does it still matter? And do you think that has slowed down or will slow down the progression towards a Web3 based financial world?
Yeah, I would say it's almost I don't think I could be more confident than this. Our financial system in the world is so efficient. It really doesn't matter how many basis points, as long as there is an arbitrage and there is a better system. There is a way to, there will be somebody who's going to harvest that. I mean, just think about people who are doing high frequency trading. They would buy the faster optical cable just to be close to the trade to make that, single basis point. So I think that is almost a foregone conclusion, regardless of the interest or environment. As long as there is an arbitrage opportunity, to Staci's point, there's a smart contract that could do it more cheaply, it's going to get done.
Also, don't forget, like on $1 million mortgage, 30 basis points is 30 grand. That's to a homeowner. That is right off the mortgage interest rate that you pay when you're buying a home, which is definitely meaningful for households.
And I would also say, if you kind of look at the parallel here is, from a very high level, the telecom industry used to be on circuit switch, right? I call you, dedicated line. That's kind of what the financial services industry is. About 15, 20 years ago, we switched to voice over IP, right? Suddenly, you have all these applications. I mean, international calls used to be what, $3 first minute, $1 a minute after that. Who pays for it? Who pays for calls, right? So I think this is basically enabling technology. I feel like blockchain at the minimum becomes an enabling technology upgrade for the financial services, but at the maximum it could do a lot more. But I think what we're talking about is we're just scratching the surface, replacing a lot of these back office paperwork with smart contracts.
So we talked about the back office efficiency, how this technology enhances in many ways, but Bitcoin was not just a technological advancement. It was what has been critical to Bitcoin, and you're hearing from many of the world's top miners today, is really the system of incentives that it created. That it's effectively applied game theory. And how it's enabled in a decentralized format to make sure that that bad actors are weeded out and that the correct state prevails. So that theory has been applied to go beyond what we can do with simple settlement of a transaction and to applied to the concept of DAOs. How can we create applied game theory and systems of incentives that are more complex in a decentralized way? So we'd love to talk a little bit about DAOs and the application of game theory in DAOs and how that decentralized governance plays a part of our discussion in the transition to, or the navigation to, a Web3 era. Staci.
So let me lead there also with an example. There is another prop tech firm built on Algorand called Lofty AI. And these are DAO-based ownership structures of rental properties. So these DAOs get together and they buy one property. Now, if you go to the Lofty AI website, you can see, and it's completely decentralized, like there's nobody to call at Lofty AI if something is happening to this property. The DAO decides. And you can see, though, the rental agreement, if a property is for sale, you can see how many times that property was showed in the last week. You can see what the management company is doing, and a DAO has actually gotten together and fired the property manager of one of these properties, and the rental income flows right through to the DAO, and they have to actively work to manage this property. And now they've got a couple of Airbnb properties on this thing as well, and it's pretty interesting.
So we property, asset management, we've seen hedge funds set up as DAOs, we've seen venture capital firms set up as DAOs. One of the also mega markets and mega use cases where there's extreme rent extraction that we didn't mention today is insurance. So Andy, maybe you could tell us a little bit about your perspective on DAOs and how they're also potentially going after the insurance sector.
Yeah, one of our investment theses is using blockchain as a tool. See if we can find offline, business model that already exists, and simply applying that technology, right? So insurance is one of the oldest model where you have a organized group of people, a mutual, right? A group of people who get together and take care of disastrous events when that's happened to a single person. So there's a company we invested actually in this region called DAO, right? It's a decentralized autonomous organization that allows you to group a bunch of people together in the case of a disastrous event, and then the money will essentially get paid out using smart contract. Right? And you essentially remove that layer of management, which, cost and whatnot. And it really reflects back to a original, very primitive form of how people work with each other. And then you simply transfer all these rules of engagement onto the blockchain using smart contract.
Another point to mention for those Islamic investors in the room is that is the power to do this within Islamic and Sharia compliant formats. And I believe DAO is itself Sharia compliant. So I was speaking to someone in this space recently, and they talk about the challenges that they have sometimes in making sure that the underlying level is truly Sharia compliant. So by having that in a smart contract functionality, you can know that you're following Islamic principles. We're running a little low on time, but I wanted to also address one more of the big use cases in Web3. We all spend time engaging with creators via various platforms, whether it's Instagram, whether it's TikTok, whether it's YouTube. Many of you may be watching this session on YouTube. Now, those platforms do themselves also extract rents from the systems. And Web3 also has the potential and is enabling creators to be able to benefit more from supporting their own creation and the systems of incentives around the creation, allowing them to engage directly with users. So would love if we could just spend the last few seconds on our panel talking about addressing creators and content within Web3. Maybe Andy, you can start on that.
Sure. I would just say this is almost another no-brainer application. There are so many benefits. I'll highlight two. One is disintermediation, the idea of putting the creator closer to their fans by removing that, Zach mentioned the rent. The rent is in the form of money as well as in the form of monopolizing the relationship. So that's one. Number two is oftentimes when these creators are getting started, they're small. So the idea of micropayment really only works if you have a highly efficient underlying system to allow young and early creators to really start building very quickly, so you don't have to get to a critical mass to be able to afford the payment layer.
Yeah, I'll say a couple of things. First of all, creators have royalty streams, and they would like to securitize those royalty streams the way that you securitize other things. And this is, of course, done in traditional finance as well. But it is much easier now. And if you use a protocol called A-Note, for example, on Algorand, you can buy a little piece of Beyonce's complete collection. Or actually, for Beyonce, it's part of a movie that they did. But you can have those musical, what are they called, like sets of songs that artists have, that you can buy a tiny sliver of those. It's not portfolio.
Albums?
But like all of the songs that an artist has, I can't remember, the name is escaping me. But you can buy a little piece of that larger asset and get the income stream from that. So that's one thing, is the securitization of royalties. The other thing is fan engagement. So you can issue coins in your name and reward your fans for engaging with you. And the interesting thing about this is that you are rewarding them for things that they do already, right? So if they, like your Instagram post or forward this or and you can see through using NFTs that they've come to the last 10 of your concerts, say. And so you can look at this and you say, oh, this person has done all of these very important fan-like behaviors and catalogs. You can have a piece of the catalog. All of these fan-like behaviors. Why? Maybe I could invite this fan to a Zoom session with me backstage, where we can engage just for my top tier level fans. And that engagement can be, it's not monetized so much, but it's accounted for. It could be accounted for properly, so that you know who your best fans are and you can reward them more easily.
So we've not only talked about huge use cases, but we've talked about application. All of these things are no longer theory; they're practice. You can see them in the real world. We're very fortunate to have been able to have panelists with us that were able to list off companies, projects, tokens, organizations that are already implementing this, and we see many others that are attacking it. So. Really appreciate the panelists coming up, and I hope this has been an informative discussion. We covered so much breadth, everything from assets, DAOs, insurance, hundreds of trillions of dollars of markets that are currently being addressed and solved for in efficiency enhancing and productivity enhancing ways on the Web3 ecosystem. So thank you very much, everyone, for the time today. Maybe Rachel will allow one question. I'll leave it at her discretion if we have time to take a question.
More to come in my breakout session down the hall in an hour or two. I think it's at 2:30.
All right. Well, I think we're 15 minutes over time, so I will have to thank our panelists and thank the audience.
Thanks.